I don't know about you guys, but I could not stand it when I would hear how these millionaires would brag about how they don't pay taxes and everyone that does pay taxes are idiots. And I'm sending money to the IRS hoping that I'll get back a decent tax return, even though it's my money anyway. It was a flex that would piss me off in the back of my mind, and I would think, how are they doing it? How can I do it? Well, in my multifamily investment journey, I've learned some of the ways that you too can uncover these tax shelters and piss off tax-paying citizens like myself, or myself before, because you can't get fooled again. Multifamily real estate investing offers several tax advantages that can help you save money and grow your wealth. Here are 5 of the most significant tax shelter benefits. And first thing, an important note is this video is not intended to be tax advice. Please consult with a qualified tax professional to learn more about tax benefits of multifamily real estate. Number 1, depreciation. We've all heard of this when we hear people talking about how they drive a new car and it immediately drops thousands of dollars when they drive it off the lot. Well, that's how depreciation works. Depreciation is a non-cash expense that allows you to deduct a portion of the value of your property over time. This can significantly reduce your taxable income. Here's an example. If you were to purchase a $1 million multifamily property, you can depreciate up to $800,000 of it over 27.5 years. This will result in a depreciation deduction of around $29,000 a year. So you're not literally getting cash in hand, but depreciation kind of acts like a shield. It reduces your taxable income and effectively allows you to keep more of the actual cash flow generated by your property that would normally go to taxes, and it goes in your hand. That's a pretty sweet deal. Number 2, tax-free appreciation. You've bought a property that's steadily climbing in value. It's going from its initial $1 million to around $2 million over those 5 to 10 years that you own it. That whole $1 million increase is like money that's quietly growing in your account, untouched by taxes until you decide to sell. This is a simple and fantastic way to build wealth over time, knowing that appreciation is working for you in the background and tax-free. But wait, let's say you want to sell that property to capitalize on those profits. How do you take advantage of all that appreciation without paying the hefty taxes to the IRS? That's going to bring us to our next tax strategy. Number 3, 1031 exchange. You've just sold the property and made a nice profit. You want to start rubbing your hands together like Birdman, but hold up! Uncle Sam's going to need some of that. Following the sale of that property, investors face the dreaded capital gains tax, which depending on the sale can be a substantial amount. How do you take advantage of the sale before the IRS swoops in? Well, I'm glad you asked. You can actually defer capital gain taxes on property using 1031 exchange. This exchange, it's like a secret weapon in an investor's arsenal that keeps tax bills at bay even longer. It allows you to basically roll out your profits from one investment property directly into another similar one. Think of it as a strategic maneuver to keep your capital working for you instead of sending a chunk to the IRS right away. To execute a 1031 exchange, investors must identify a potential investment replacement within 45 days of the sale and complete that purchase within 180 days. This is a powerful tool, so make sure you're on your toes with the deadlines and you can keep your momentum going. Number 4, passive activity losses. Think of passive activity losses like having a bit of your bad luck or expenses in one of your investments, let's say a rental condo or something has unexpected repair costs and you end up losing a little money that year. Now, if your multifamily property investment is doing well and generating some winning money or taxable income, the IRS lets you use the bad luck from one and basically balance some of your good luck from the other. So you don't have to pay so much in taxes overall. It's like saying, hey, I lost a little bit over here, so can we count that when figuring out how much I really made over there? Here's an example. You own a small vacation rental house that had a slow year with fewer bookings, and after all the expenses, it ended up losing $5,000 on paper. Now your multifamily apartment building down the street generated taxable profits of about $12,000 this year. Because of the passive activity loss rules, you might be able to use that $5,000 loss from the vacation rental to offset the $12,000 you made from the multifamily. So now you're only taxed on $7,000. It's like getting a $5,000 mulligan on your tax bill thanks to the other investment. It's important to know there are specific rules and limitations around passive activity losses, so it's always best to speak with a tax professional to see how they apply to your situation. Number 5, operating expenses. Think of operating expenses as all the bills your property has to pay to stay in tip-top shape and keep the rent checks rolling in. It's like your property saying, hey, I had to pay electricity so the tenants can see, I need insurance to protect everyone in case of emergencies, and my property manager deserves a paycheck to keep everything organized. The cool thing is, the IRS lets you subtract all these business bills from the money your property generates before they figure out how much you owe in taxes. It's like getting a discount on your taxable income just for not being a slumlord. Here's an example. Let's say your apartment building is a money-making machine. It brings in $100,000 in rent each year. But just like any good business, it has its cost. $10,000 for keeping the lights on and running water and other utilities, $5,000 to keep everyone protected with insurance, $10,000 to pay your property manager who handles all the tenant stuff that you don't want to, $5,000 for little repairs here and there to make sure that everything is working and looking good. That adds up to a total about $30,000 in business bills or operating expenses. Now, instead of the IRS saying, hey, okay, you made $100,000, time to pay taxes on that full amount, they say, hold up, your property had $30,000 in legitimate expenses to keep running, so we'll only tax you for the remaining $70,000. That's like getting a $30,000 expense coupon that lowers your tax bill. That's great, but just remember, these need to be real, necessary expenses that keep your property functioning. So there you have it. 5 solid ways that diving into multifamily real estate can help you keep more of your hard-earned cash out of Uncle Sam's hands. Remember, it's not about being an idiot for paying taxes. It's about strategically leveraging the rules of the game to build your wealth smarter. Forget just hoping that a decent tax return will come your way. With these multifamily strategies, you can proactively sculpt your tax situation and keep more of the profits where they belong, with you. It's time to level up your investment game. Let these tax benefits work in your favor. If you're interested in learning more about the tax benefits of multifamily real estate investing, please contact me. I would be happy to answer any questions you have. I'm Salim. Thanks for watching.